U.S. natural gas futures extended gains for a fifth consecutive session on Wednesday, driven by forecasts for intense heat and sustained liquefied natural gas export strength. The main catalyst remains the hotter than normal temperature outlook. Weather analysts project widespread highs in the upper 80s to low 100s across California, the Southwest, and Texas over the next 8 to 15 days. Elevated power burns due to strong air conditioning demand are boosting utility consumption of natural gas. At the same time, LNG export flows remain near record highs, providing additional price support despite weaker overall domestic demand data. Estimated net flows to U.S. LNG terminals stood at 15.2 billion cubic feet per day on Monday, only slightly lower on a weekly basis. On the supply side, U.S. dry gas production remains steady near 107 billion cubic feet per day, up 3% from a year ago. However, domestic demand has softened, falling to 79.5 billion cubic feet per day on Tuesday, June 5% below year-ago levels, limiting some of the bullish momentum. Meanwhile, the latest EIA report added support to prices, with storage increasing by just 53 billion cubic feet for the week ending July 4, below the 61 billion cubic feet consensus and matching the 5-year average. Attention now shifts to Thursday's EIA storage report, which is expected to show a 48 billion cubic feet build, well above seasonal norms. Still, price reaction will depend on the actual figure. An injection below 48 billion cubic feet could spark further gains, while a higher build may trigger a sell-off, especially with the market appearing technically overbought after the recent rally. The near-term technical setup for natural gas futures maintains a bullish bias, particularly if prices can sustain momentum above the short-term pivot level at $3.57. A successful hold above this area could open the path for a retest of the next key resistance around $3.73. Breaking through this threshold may encourage further upside, especially if weather-driven demand or export flows continue to support the market. However, the rally is starting to show signs of exhaustion, with technical indicators suggesting overbought conditions. Combined with expectations for a bearish storage report this week, the risk of a corrective pullback is growing. If the storage data disappoints the bulls, prices could slip below the $3.50 support level. A decisive break under this point would be technically significant, as it may flip this area into resistance in the near term. This risk is compounded if domestic production remains elevated and consumption trends stay soft, which could further weigh on prices and limit the sustainability of the recent rally. Please like, subscribe, and comment to support the channel. See you in the next one.